Hello guys, welcome to Breaking Chart Alerts. This is Dave Santarelli. Tonight we are doing a class on covered calls. Let's get started. So first off, what is a covered call? All right, now first off, you guys know when we're buying options, we're buying, okay? We're paying a premium. We're paying a premium for the right to that option. When we're doing covered calls, covered call is a popular option strategy used to generate income in the form of option premium. So instead of being the option buyer, we're going to be the option seller, but it's going to be a covered short sale. Okay. So to execute a covered call, an investor holding a long position in an asset then writes or sells calls against that asset. It is often employed by those who intend to hold the underlying stock for a long period of time, but does not expect an appreciable price increase in the near term. This strategy is an ideal strategy for an investor who believes the underlying price will not move much over the near term. Why would you want to make a covered call? So this is really great for those with larger accounts or those that trade smaller shares in lots of 100, because what this is going to do, it's going to bring in additional revenue and it protects you to the downside. So let's say, for example, you like Apple. You think, okay, during this market volatility here, Apple might drop down a little bit and you want to take advantage and bring in additional revenue and sell some covered calls against your shares, but you're still bullish and you want to hold those shares for the long term. So we're going to show you exactly what we mean here. So you make a covered call to bring in additional revenue and to protect your shares to the downside. Selling covered calls. When you sell a covered call, you get paid in exchange for giving up a portion of the upside. Okay, so just like a spread, you guys are familiar with the spread, right? We buy a call and then we sell a higher call. Okay, that's giving up future upside by selling to open that higher strike, creating that spread there. So it's just like that. And I'm going to go over some examples. So here's a bearish scenario. Okay. Let's say January 1st, you come along and you're buying XYZ shares at $50 a share. Okay. Let's say you bought 1,000 shares. Okay. 1,000 shares, that's going to cost you $50,000. Okay. So 1,000 shares, remember, just like options, there's 100 shares in a contract. So if you bought 1,000 shares, 1,000 divide that by 10 or divide that by 100 is 10. So you could sell to open 10 calls. So January 1st, you go in and you decide you want to sell XYZ call option for $4. Now remember, $4, there's 100 shares per contract. So you're going to be collecting $400 per contract. And if you sold to open 10 calls, you're going to be collecting $4,000. So let's say you come in and you sell XYZ call option for $4 and expires on June 30th. It's exercisable at 55. So you're selling to open that 55 strike call. So keep in mind here, you bought the shares at $50 and you're selling someone the right to buy them off of you for 55. It's just the same as buying the 50 strike call and selling to open the 55 strike call and creating that spread. The max you can make on this trade is the difference between what you bought the shares for and what you're selling someone the right to them for. So between that is $5 plus the $4 in premium. Okay. So now let's say June 30th comes along and this stock closes at $40. The option is not exercised and it expires worthless because the stock price is below the strike price that you sold. There's no reason that they're going to go in there and buy it for $55 when they could go to the open market and buy it for $40. So the option buyer has no incentive to pay $55 a share when he or she can purchase the stock at $40. So what's your loss here? You're not having any loss here. So all it is you're having the loss in the underlying shares for the short-term period. So from 50, if you bought the shares at 50, you sold the 55 strike, you're bringing in that $4 or 400 per contract. The stock closes at 40. So you're losing $10 there on the shares from 40 to 50, but you collected a $4 premium. So your real loss there is $6 or only 12%, which is minimizing that downside risk. And what's nice about this is during a bearish scenario. Now here's a bullish scenario. So let's say shares rise to 60 bucks and you bought those XYZ shares at $50. And at January 1st, you came in XYZ, you sold that call option for $4 for the 55 strike for June 30th. The stock closes at $60 on June 30th. Option is exercised because it is above the $55 and you receive $55 for your shares. So you paid $50 for your shares and now you're receiving $55 for them. See how it's limiting your upside, because even though the stock's at 60, you sold to open that 55. Now, the reason why I'm going over this now before we go over to the charts here is because we could utilize our trade plan to maximize the strike prices and premiums that we're going to be collecting on those covered calls here, utilizing our trade plan. So June 30th comes along, the stock closes at $60. Options exercised because it's above 55 and you receive $55 for your share. What's your profit? Your profit is $5, okay, from where you bought it and where you sold it. So from 50 to 55, you made $5 capital gain. Plus you collected $4 in premium from the sale of that option. So you made really $400 per share, or per contract that you're selling. $4, multiply that by 100 is $400. So you're collecting that $400 per contract. So if you had those 10 contracts, you just made $5 per share. And if you had those 1,000 shares, obviously that's $5,000. $5,000 plus that 400 times that by your 10, that's $4,000. So you made $9,000 if you're using that 1,000 shares as an example here. So you profited $5 capital gain from where you bought the shares and the strike you sold, plus the premium you collected from the sale of that option. All right, so when to create a covered call and how to do it. First off, it's the most basic, simplest strategy to use. All you need is level 1 options. Level 1 options, you have really no risk here, because the only way you could sell a covered call is as if you own those shares, okay? So you purchase a stock and you're buying it in lots of 100 shares. You're selling a call contract for every 100 shares of stock you own. One call contract represents 100 shares of stock, just like when we're buying them. If you own 500 shares of stock, you can sell up to 5 call contracts against your shares. You can also sell less than 5 contracts, which means if the call options are exercised, you won't have to relinquish all of your stock position or all of your shares in this example. So in this example, if you sell 3 contracts, and the price is above that strike price at expiration, 300 of your shares are going to be called away or given away to that call buyer that bought those calls off of you. And it's delivered to the buyer who exercises the option. But since you only sold 3 contracts and you own 500 shares, you're going to still have 200 shares remaining in your account. Now, wait for the call to be exercised or to expire. You're making money off the premium the buyer of the call option is paying you. If the premium is 10 cents per share, then you make that full premium if the buyer holds on to that option until expiration and it's not exercised. You can buy back that option before expiration, but there's little reason to do so. But that's for short term. We're also going to go over a long-term strategy as well, where it's nice to buy back that short leg. Just like with vertical spreads here, you know how when we come down to support, I always tell you guys this is where I like to buy back that short leg if I still have a long-term position that I think is going to continue higher. Because what we could do then is we could buy back that short leg there or buy back that short contract, lock in that profit, and then when the stock starts to rise again and gets up to that resistance, then we could sell another contract against our shares. So what are the risks of a covered call? The risk of a covered call comes from holding the stock position. That's it. You don't have any risk whatsoever selling that covered call. All that you're responsible for are the share prices. So just like if you own a share at $10, it drops down to $9, you lost $1 per share, right? Well, with selling a covered call, there's no added risk to that. Your maximum loss occurs if the stock goes to zero. Now, profiting with covered calls. The maximum profit of a covered call is equivalent to the strike price of the short call option less the purchase price of the underlying stock plus the premium received. So the mathematical formula looks like this. Max profit equals strike price minus stock entry price. So again, strike price. Let's say you're selling the 55 strike. You bought the stock at 50. So that's $5 plus premium received. Okay, now we're going to be going over some examples here. So now let's go over some examples, guys. So first off, let's look at SPY. So what I like to do when utilizing a covered call is, you guys know our trade plan, right? So we're buying a call, for example, when we get that 1020 cross. Okay, now here's the thing, guys. If you're buying, you could do the same thing with buying shares. When you have that 1020 cross, the MACD cross, first candle above that 1020 SMA, it's either A, you could buy calls here, or B, you could buy shares. So let's say that you're utilizing our trade plan to buy some shares here instead of calls. So you can see the example here of what we're doing. So let's say we get that 1020 cross on April 6th here, and we buy some shares of SPY at, let's say, $260 a share. Okay, now what I want you to realize here is if you're buying shares for the long term, okay, the 10 and 20 SMA are for short-term trades, anywhere from a week to, 3 to 6 months long. Anything over that, you're really focusing on the 50 or the 200-day simple moving average. I always like to stick with the 50-day simple moving average compared to the 200-day simple moving average, unless I'm holding on to that for like 2 years. So if you're getting some leaps, for example, something that's longer than a year out until expiration, then you could use that 200-day simple moving average just by going up to studies and going down to moving average and adding the 200-day moving average to this, which we could put as weight, for example. So there's that 200-day simple moving average. So what I'm saying is if you have something longer than a year out, you could say your stop is going to be the first candle below that 200-day simple moving average. But we're not going to do that in this example. So let's say you bought the shares at $260. So I'd like you to write this down. You bought the shares at $260 a share. Okay? Let's say now that, let's just say, for example, we're still above that 50 SMA right now, and we're just going to be below it. Okay, let's just say we're right up here, and we're just getting ready to drop below it here on, what's that, September 17th. So now we're profiting on our shares this entire upside. What I personally like to do is to cover yourself, because remember, the main reason you're selling covered calls is to protect yourself from the downside and to bring in additional premium. So there's two ways of doing this. Either one, you're going to be selling covered calls every month here on the way going up, and you're just going to the next month's expo, you're looking at where resistance is, and then you're selling that strike at resistance. So for example, if you have some resistance, if we go back here, we have some resistance right at around 300 on SPY, then you'd be selling a month out that 300 strike. So if you're buying at 260 and you're selling to open that 300 strike, then your calls or your shares are only going to be taken away if the stock's above 300. But the nice thing about that is if you're buying the shares at 260, you got plenty of time before you get up to that 300. And even if you do get up to that 300, you're making $40 per share plus the premium that you're collecting on this. Okay. So that's one way of doing it. Every single month you sell a covered call. So for example here, let's take a look at SPY. So let's say you have SPY and you want to sell a covered call, right? So let's say you wanted to do that now. It's at 334.38. You'd go a month out till Expo. So right now we're at October 1st. So October 16th is a little too early. So we'd go with the November monthly Expo. And always I like to use the monthly Expos. I'm telling you, never use the weekly Expos because A, there's less volume on the weekly Expos. Look at the weekly Expos here for November 6th on SPY. You got 10, 31, 68, 250. But when you look at that November 20th, which is a monthly Expo, you're getting thousands of contracts that are being bought and sold. So it's really important to have that liquidity when you're looking at collecting that premium on a monthly basis. Because what this is going to do, if you own the share, if you buy the shares here and you want to utilize this strategy, that means you could be collecting a premium, collecting basically a paycheck every single month by selling to open that strike at that resistance and collecting that premium. So what that does is you're making money as the stock goes higher, plus you're collecting that premium. And those of you that are members know that when we are buying options, we're paying for that option. When we're selling, we're actually the option seller here. So we're selling someone the right to our shares at a certain price. Okay. So that's one way of doing it. You buy the shares and every single month you're looking for that extra income coming in, that paycheck type of trade. Okay. And the only way that you're going to get those shares taken away for you is if the shares are above that strike that you're selling. And that's why it's important to look at those resistance levels that we're talking about, like 300 here. If you're buying the shares at 260, you're looking back, seeing where that resistance is, you're seeing 300. So then you would sell to open the 300 strike for a month out. And then once that month comes, if the shares are below that, you keep that premium, you still have your shares, and now you could sell another month out premium. And if you're getting up close to that resistance, then you're going to be looking at your next area of resistance, which as you can see back up here is about 325. So then once you get here and you're saying, okay, we're getting up to it, sold that month out. Now we're going to be selling open that 325 that we just talked about. So then you're collecting that premium from that month all the way up. If it doesn't get to 325, again, you keep your shares and you still keep that premium. So every single month you're able to collect that premium. Now, here's the thing, guys. So that's one strategy, is to utilize covered calls to bring in premium every single month. All right, so the other strategy, like I said, strategy number one is to collect additional revenue, additional income every month by selling covered calls against your shares. Number two is to protect yourself from the downside. Okay, so let's say now that you've owned these shares the entire time here, you've been bullish, it's a stock that you want to own for a couple of years, something that you have in your 401k, and this is something you could do in your 401k. So let's say that you're still bullish on SPY, but you want to protect yourself to the downside. We're going to be utilizing that 50 SMA with our trade plan here as a way to protect ourselves. So now if you bought the shares at 260, what we're going to be doing is selling a covered call at resistance when we break below that 50. So now we bought the shares of SPY at 260. This entire time, the candles were holding above that red 50-day simple moving average. So during that time, we're collecting on the share increase. So from 260 all the way up to 350, we even got up to almost 360 here. We almost made $100 per share. So let's say we bought 1,000 shares of SPY. 1,000 shares of SPY at 260, 1,000 times 260, that's $260,000, right? Now you got all the way up to about $360. So you made $100 profit on those 1,000 shares. So you just made $100,000 profit on that move higher. So now what are you going to do to protect yourself from that $100,000 profit you just made if you think, okay, you know what? The election's coming up. We might pull back again, but I want to hold on to these SPYs because I'm still bullish. It's in my 401k and I want to hold it for the long term. Well, this is where it's going to get great because this second strategy is going to protect you on the downside. So like I said, you just got up to, let's say 360, you made $100 per share. And if you have 1,000 shares, you know, obviously 1,000 shares, divide that by 100, that's 10 contracts that you could sell. And what you want to remember here is that you're only going to sell to protect yourself on the downside. So if we get that first candle below that red 50 SMA, that's where we're going to be selling to open those calls. And what we're going to be looking at for the strike we're selling is that strike that we had. And then again, this is the time that you're saying, okay, this is a longer term trade. You're holding their shares for a couple of years or longer. It's in your 401k. So that's going to be something that you could go for a few months out until whatever it is. Like for this example, the election's coming up, right? So you could give it until about December or January of 2021 and sell some covered calls. So let's just say we just got that cross below on that 50 right now. And we want to look to go out to the January 15th monthly expo here. And we want to sell those 350 strike calls, the 350, or we could go up to the 360. So now what we do is we come down here on the call side and we look at all of our options, all of our strikes. We come down and we look at that 360 and we see that that's going for $635 a contract. So right here, you guys could see that 360 strike is going for about $6.35 a contract. Okay, so if you own 1,000 shares, you bought 1,000 shares of SPY at 260. $260 a share. That means you paid $260,000, right? That 1,000 shares, remember, there's 100 shares per contract. So 1,000 divide that by 100, you can now sell to open 10 contracts. Okay, so now all you're doing here is you're going down to your option chain, you're putting in call, you're putting in your expiration date, January 15th, you're going to your strike of 360. You're seeing that it's going for 635. The bid is 630, ask is 635, so the midpoint's going to be 635. You plug that in, 10 contracts. Remember, 100 shares per contract, so 635, 6.35, multiply that by 100, that's $635. Multiply that by the 10 contracts, that's $6,350 that you're going to be collecting in premium. So now here's the nice thing. What you're going to be doing, that first candle you got that's below that 50 SMA, that's when you're going to be selling that next resistance area for that strike. That's how you're going to be finding that strike that you want to sell to open. So that's how we came up with that 360. We have the first candle below that 50, and we're looking back at the chart. We're saying, okay, where's the high in that recent breakout? Because usually when it crosses below that 50 on a daily chart, it's pretty close to where the highs were. So as you can see, we had the highs right here on September 2nd on SPY, and then we had our first candle below that 50 SMA on September 18th. So on September 18th, you're saying, okay, these shares were just at 360. Now they're down to 330, right? So you just lost $30 per share. $30 per share on 1,000 shares, that's $30,000. You have no way of protecting yourself to the downside yet. So what you're doing here is you're selling to open those 10 contracts against your 1,000 shares. You're bringing in $6,350 by selling the January 15th, 2021 expiration. And so now what's going to happen is you automatically bring in that $6,350. That's yours. That's yours no matter what. Whether the stock gets to 360 or it drops to zero, that premium that you're collecting is yours. Now, here's the thing. If the stock starts to drop here, this is going to become profitable, because as we get further away from this strike, think of it as we're the option buyer. You guys know this example perfectly well. Let's say we buy the 360 strike right now. We want the stock to go to 360 or higher, right? Well, now what happens if it doesn't go to 360 and we start to drop now? This is going to become worth less money. So now if we did that today, we sold to open those 10 contracts. We collected that $6,350 in premium against those 10 contracts, those 1,000 shares that we own, right? So we're collecting that $6,350. Now, let's say the stock goes against us and it starts dropping. Well, what if this goes down to $3, and it drops down to about $3.20 a share? We're at support right here. We drop down to $3.20. This is the next support area, is at $3.20, and then we start to hold there, consolidate, and start to climb. Well, once we come down to that $3.20, this option is obviously going to be worth less. So let's say this gets down to $3 a contract, okay? That means we could buy this back then for $3, and guess what? We just profited from the difference between where we're buying it back from and where we sold it from. So that $3.35 or $3,350 is ours. And when we buy back that short call there, obviously then we're only doing that if it's coming down to support and starting to climb again, because obviously we want to keep continuing to capture that upside if we're bullish long-term on our 1,000 shares. So if we still think SPY is going to be heading higher over the next year or so, then obviously when it comes down to support, holds it, and starts to climb, we want to buy back that short leg, profit from it, and then let those shares run and let our shares make us money still. Okay, so let's just say, for example, now we sell to open that 360 and something crazy happens. Unemployment comes out tomorrow. We get a big candle and now we're up to 345 tomorrow, right? Obviously, these are going to be worth more. So then we're going to have a short loss on our covered call. If we wanted to buy it back, we don't have to buy it back though. But if you wanted to buy it back and stop the risk on the upside, because remember, if you sold to open that 360, the max gain you have is from where you bought it at 260 to where you're selling it at 360. So your max gain there is $100 for shares. So 100 times that by 1,000 shares, that is $100,000 plus the premium you're collecting, $6,350. So that's going to be your max gain if the shares are above 360 by your expiration date. So you profited from where you bought it at 260, and then the strike that you're selling 360. So you're making $100 per share. $100 times 1,000 shares is $100,000 plus that premium you're collecting from selling someone the right to your shares at 360. So you're collecting that $6,350. So here, for example, 360, divide that by 260, you made a 38.46% return from buying it at 260 and selling it at 360. But you're collecting an additional premium here from selling that covered call. You're making an extra $6,350. So 360 plus 6.35, that's 366.35. Divide that by 260. Now you're making a 41% return compared to that. So you're making a 41% return with those covered calls compared to the 360, divide that by 260, which was the 38%. So you're making an extra 3%, and that might not sound like a lot there, but that's when you're doing leaps for an extra year. And that 3% is quite hefty there if you continue to do that. Now, if you're doing that on a monthly basis, right? So in that example here, we're doing that to protect ourselves in case the markets might start to drop here and continue lower. Whereas the other example, we're going to be doing it every single month against whatever you own at least 100 shares of, you could sell some covered calls and bring in additional revenue. So it's really nice to be able to use that strategy there on a monthly basis. That's why once you grow your account utilizing stock options here, then in that other account that we have the shares in, we could start buying shares and selling covered calls against those shares to bring in even more revenue. So then you're profiting from the shares going higher, and you're profiting from collecting the premium on those covered calls. Let's do one more example here. I wanted to share with you guys. Let me get annotation off of here. So AMC, for example, a few of our members had AMC shares assigned to them. Okay, I think it was the 6th strike that they had. Now, obviously, if you zoom out of here on AMC, you see the pandemic really hit AMC really hard. I mean, this was a stock that was 21 bucks just, a year ago, 2 years ago. So 2 years ago, this stock was 21 bucks. It's at $4.79 now. So if you're bullish on AMC, let's say you had 10 contracts, right? If you had 10 contracts, multiply that by 100, that means you have 1,000 shares. 1,000 shares of AMC is only $4,790. So let's do the math here. If you own 1,000 shares of AMC, that's the movie theater, at, let's say those were exercised at $6. That means you own $6,000 worth of AMC stock. Now, the nice thing about that, you're able to sell to open 10 contracts of AMC. So now if we go down here and we look at this and we go to call, and now if you're saying, hey, I got to exercise these options here, and I'm still bullish on AMC, so I really don't want to get rid of the stock and take a short-term loss here. I want to hold on to these for maybe a year or two. And once COVID rebounds, that stock might be back up to 15 to 20 bucks a share. Well, then what you want to do is look at maybe something like the January 2023 Expo, 3 years out, 2 years out until expiration. Now, if we take a look down here, we could sell to open let's say the 12 strike call here for about $2.42. So in this example here, if you're selling to open the 12 strike call for, theoretically, it's going for $2.42, right? So this is going for $2.42 a contract, which is $242 per contract, okay? So now remember, you own the shares at $6. The max you can make is the difference between that strike price and what you bought the shares at. So 12 minus 6 equals 6. So you're going to profit $6 per share. So $6 per share. So now if you have 1,000 shares, remember you have 1,000 shares, that means you just made a $6,000 profit on the shares. Plus, if you're selling to open 10 contracts, 10 multiply that by 242. Because remember, there's 100 shares per contract. So you have to multiply that 100 shares by that option premium. So 2.42 multiply 100 is $242. $242, divide that by the shares we own, how many contracts we could sell. We could sell 10 contracts. So 242 times 10, that's going to be $2,420. So now instead of just making a $6,000 profit on the premium there from the shares increasing in value, we're also collecting that premium from selling someone the right to those calls at those shares at $12. So now we have a net profit of $8,420. So if we only own the shares, we'd be making a max profit of $6,000 if the stock got up to $12. With selling the covered call, we're bringing in an additional $2,420. So instead of only making $6,000, now we're making $8,420. So instead of making what is this? So 12,000, so 6,000 plus 6,000, that's 12,000. Divide that by 6,000, that's obviously a 100% return. Now, 6,000 plus $8,420 equals $14,420. Divide that by 6,000. Now we're making 141% return. So in this example, we make 100% return. And in this example here, with selling those covered calls, we're making 140.33% return. So you can see you're collecting an extra 40% by selling the right to those shares there at $12. So selling covered calls against your shares that you're holding long-term is a great strategy to bring in that additional revenue. Okay. It says quantity and contracts. So in this example here, I totally forgot to go over that with you. So you're looking at the January 20, 2023. You're selling to open the 12 strike. You're bringing in, it's going for right now, theoretically 242. So you put in 242. And then since you already own 1,000 shares, this isn't going to be a naked position. If you did not own those 1,000 shares and you went to sell to open, this would be a level 4 option and you'd be at max risk here. So if you didn't own those shares and you went to do this, you could lose much more money than what you have in your account. So that's why level 1 is all you need to sell covered calls, because you have the shares to cover yourself if that stock does get up to that price. So that's why it's called covered call. You're covering yourself and there's no risk here with selling to open that strike. So now what you're doing here is if you own the 100 shares of AMC bought at $6, first off, you really don't want to sell to open until you get up to that next resistance. So once you get up to 750, then you could sell to open the 12 strike. But what you're doing here is you're going to sell to open. So if you have 500 shares, then you're reducing this down to 5 contracts. If you have 300 shares, you're reducing this down to 3 contracts. If you have 10,000 shares, then you could go up to 100 contracts and collect $24,200. Okay, but in this example here, we have 1,000 shares. So 1,000 divide that by 100 equals 10. That's how we got the contracts that we're able to sell. So now to create this covered call, all you're doing is you're going over to your order entry and you're clicking sell to open. You're selling someone the right to your shares. So to open that transaction, you're selling to open that transaction. Now, if you ever wanted to buy it back, then you're buying to close that strike. But whenever you're creating that covered call, you're selling to open to create that covered call, and you're collecting that premium. So like I said, if you bought the 1,000 shares of AMC at $6 and it gets up to $12, you're only making $6 per share on that 1,000 shares. So now your $6,000 is now worth $12,000. You made a $6,000 net profit. But if you sold to open that 12 strike call and it gets to 12 or higher, now you're making that the 6,000 you originally had. Okay, so you had the 6,000 you originally had bought the shares for, plus you made that $6,000 for it getting up to 12. So plus another 6,000, plus that $2,420. So your original $6,000 trade is now worth $14,000. So now your original trade that you bought for $6,000 is equal to $14,420 if you sold to open that 12 strike call. So you just made $14,420. That's what it's worth now if you bought the stock for $6,000. So that's the importance of those covered calls. They're going to increase your revenue drastically. You see here 40.33% extra rather than that 100% if you just own those shares and it went from $6 up to 12. Obviously 6 to 12, that's 100% return. That's how you got this. So your initial 6,000 plus the 6,000 you profited to the upside, plus that $2,420 you collected in premium equals $8,420 net profit plus your original investment of 6,000. So that's what gives us that 14,000. That's what gives us that $14,420 profit right here. Is the original 6,000 plus the 6,000 that we made from it doubling, plus the 2,000 from selling the calls. So that's $8,420 net profit plus our original investment of 6,000, and that's how we got that equals $14,420. So that $6,000 is now worth $14,420. And the nice thing about that is you have till January 2023. You know, you got 2 years for that to get up to that 12 bucks. And that's a hell of a way to make 140% return. Wall Street averages between 7 and 9% a year. So even if it took 2 years, Wall Street's only making, let's say they make 8%. So in 2 years, they made 16% compared to you utilizing this and utilizing the trade plan and making that 140.33% return. I mean, take a look at SPY here. If you look at SPY, you know, and you go out to January 21st, 2022, I mean, you could see, you know, the 350, you got some good, like here, the 400 strike, you got 2,800 contracts open interest there. You know, you got plenty of volume. So there's many things you could do. You know, you want to obviously look for those solid stocks that have some good open interest, some good volume, and that are well-known stocks, because obviously that's going to be the ones that the contracts are going to be coming in and out of. You want that liquidity. I had some members that took a $9,000 account to $110,000. I had another member that took $15,000 into $300,000. You know, like there's so many different scenarios of members that took a small account to a large account. But what they fail to realize is what you want to do to save that, because you guys see what happens in market pullbacks. Your active option trading account could drastically pull back. So that's why what I like to say there is once you get your account over, let's say 20,000, 25,000, after that, once you start, let's say you make $1,000 today, take 40% of that. Take $400, put that in your other account. If you make $10,000 for the week, put 40%, $4,000 into another account. And as you continue to grow your account there, you're going to look at that other account. You're going to say, wow, I just saved $50,000 in that other account. And then what you could start doing is buying shares of stock and utilizing this covered call strategy. And not only are you making money as the stock goes higher, but you're still making money as you're collecting that premium every single month. So that's the real reason why you want to do those covered calls. And you want to do that in a separate account, because it's going to be tough for you to be looking at that every day compared to all the options in your account. So that's only level 1. So you can have that in another account there and just transfer your profits from your active trading account into that other account there. So I hope that helped everyone tonight. And if you guys need any other further questions, you shoot us an email at support@breakingchartalerts.com. Alrighty, guys, thank you. Have a great night, and I will see you guys tomorrow. Bye-bye, and stay safe.